So how do you not drain that 401k to zero when you retire? How do we guard against that? Well, that's what this video is all about. I'm Chris, president of First Shelbourne, a registered investment advisory firm here in Comac, New York. I manage a lot of portfolios for retiring police officers, business owners. I myself am a retired police officer here in New York. I did 20 years. It was an interesting career. So I know a lot of police officers retire, and the first thing they usually get is they maybe get someone trying to sell them an annuity that's extremely high fees or some insurance policy that just doesn't fit them. A lot of these officers already have a pension. They most likely don't need an annuity. So what we're going to talk about in this video is your 401k, 457 plan, basically how it could be used as a tool in your retirement to supplement your pension. So be careful with the thinking that just because you have a pension that you could take so much more risk with your 401 or 457 plan. This usually isn't the case. From everything I've seen, people say they want to take a lot more risk, but then all of a sudden the market careens lower, and then they start panicking, and the worst thing you could do is now start selling in a down market. So we're going to talk about an interesting concept today that a lot of people don't know about, and it's called the sequence of returns risk. And what is this? And it's an extremely interesting concept. And the concept is so important that this is the main reason people get hurt when they listen to, say, a friend or family member to sort of guide their retirement. So you might get, say, a police officer, a teacher, even a business owner that has an individual 401k. You'll get an individual that just plows money into a 401k their whole career. They've built up a substantial balance. And now when they retire, they're pretty much left to manage this asset. And a lot of times what these individuals do is they go to family members or friends for advice. And the blanket advice that usually comes from these individuals, without even knowing about somebody's risk tolerance, their emotional outlook of how they react towards collapsing markets, a lot of times people will just say, just buy an S&P 500 index fund, set it and forget it. That's probably some of the worst advice you could get. Because it doesn't take into account what I'm going to talk about here, and that's the sequence of returns risk. So if you are retiring, be careful about taking advice from some family member that really doesn't know what they're doing. And you should always ask yourself, too, is the person that I'm taking advice from, are they in a situation that I want to be in? I always say that. So when I look at investing, I read all of like Warren Buffett's shareholders, and I say to myself, well, do I look up to this person, and would I like their financial situation? And if the answer is yes, then okay, maybe taking some guidance from that person might be beneficial. But you always have to be careful who you take advice from. So let's look at the sequence of returns risk. So let's pull up a chart right now. This is a really good chart. It's actually from BlackRock. And what you're looking at right here is 3 different portfolios that all have the same compounded return over 25 years. So this portfolio starts at $1 million. So say someone retires, they have a really large nest egg of like $1 million. It's a large amount. But the only difference here is the sequence in which those returns occur. So although what you're looking at is they both have 7% returns, the top portfolio in red starts at year 1 making 22%, then year 2 it makes 15%, then 12%, then it loses 4%, and it loses 7%. Then the yellow portfolio is just that in reverse. Okay? So instead of making 22% in the first year, it's on the last year. So it's all in reverse. It starts off losing money. So minus 7%, minus 4%. And then portfolio B in the green is just 7% across the board. Now, we all know markets, if they make 7 or 8% compounded over the long term, the market does not make 7 or 8% per year. That's not how markets work. Markets are extremely volatile. They'll make maybe 25% one year and lose 7% the next year. But when you average it out, that's how you get that market return. Now, the danger is thinking that if you invest in the stock market, you're going to get that return. That's the danger, because you don't know what time frame that average return happens. Remember, we've had lost decades in the stock market. What is a lost decade? It's when you have basically no return or negative returns over a long-term period. And it's happened many times in the United States. Now, if you're pulling money out during that negative return, this is when it really hurts you. So let's look at the next chart. So the first chart you're looking at is you're in the accumulation phase. You're not taking any money out. That's what this chart is showing. 7% is 7% no matter how that 7% comes about. If you make a lot and then you lose in the back end, or you lose in the front end and then make a lot. Now, the next chart is going to be when you're withdrawing money. And why is this so important? It's because 401k plans, 457 plans, all these tax-deferred IRAs, they have what's called required minimum distributions. So you have to take money out, even if you don't want. So when you get, it's different, but when you reach around 72, 73 years old, you have to start withdrawing on the money. Now, when you start withdrawing, that sequence of returns that we just saw up top, it matters so much. So let's look at this chart. We could see here, if we take portfolio C, that's the yellow, and let's say it just starts off with 2 bad years. It shows here minus 7% and minus 4% while you're withdrawing money. You could see here that the portfolio actually runs out of money when the person is in their 80s. It's a zero balance. As opposed to portfolio A, where it's reversed, you have the high returns in the beginning, same return. That individual still has $1.1 million at 90 years old, so many years after the other portfolio ran out of money. So this is the whole thing when it comes to retirement planning that a lot of people won't tell you. It's why bonds are so important too. It's why you can't just listen to someone that says, oh, you have a pension. That's sort of your bond proxy. So you need to take as much risk as you want in your 401k and 457. No, it's the worst advice. You have to be very, very careful. You can do it, but you have to know the risks. You have to know that when you start withdrawing money, you could get hit with a negative sequence early on, and it could cause you to have your account really go much lower than what you might have thought. So at my company, I use a more conservative slant when investing funds. First of all, most people will say they're high risk and they like high risk, but the minute the markets start careening lower, a lot of them panic. Most people actually, it's usually a step lower. If they think they're aggressive, they're probably on the moderate end. And the job of a good investment advisor is to understand, the risk profile of their clients and to prevent them from, selling their whole portfolio at the wrong time. Now, we don't want to be too conservative. That could also not be good if you're too conservative. But I've seen with individuals, especially individuals with large 401ks, you really can't be too conservative, especially today when bond yields are not 0%. You see, a decade ago when bond yields were, you're making 1% on your money, it wasn't even worth owning a bond. Today's completely different. Interest rates have risen, and fixed income investors are getting a decent return on their portfolio. The risk-free rate on short-term 3-month treasuries is over 3.5%. That's a risk-free return. Now, if you start going into more short-duration corporate bonds, it starts getting higher. intermediate corporate bonds right now are paying over 5%. Now, with interest rates changing, that could change, but there's ways to construct a bond portfolio where you're not taking that excessive stock market risk. Now, with bonds, you have to also be careful about a lot of things. If you have a manager that doesn't understand bonds and how they work and duration and how volatile these long-term bonds can get, you're in for a rude awakening. So the investment manager really does have to know how to construct a bond portfolio as well as a stock portfolio. But if you're a retiring police officer, be careful when you get that advice to just go full on, take as much risk. It usually ends in disaster. A lot of times what happens is a lot of these officers, they might go to an advisor and they'll have really large drawdowns. They kind of sell out and they just really take sort of a long-term impairment. And you don't want it to ever get to that point. You want to stick with your plan, be able to stay on that plan, even if it means making a little less money than the person who's in tech stocks making all of this money. Most of those people, the do-it-yourself traders out there, they end up all blowing up. And your competition is not them. Your competition is just yourself. Especially for police officers, you earned a pension. You have this income floor. And now basically you have this 401k and 457 plan that you could generate pretty much a second pension. I deal with a lot of rollover IRAs because I've noticed that a lot of the assets within the plan, if you keep it in that plan where you worked, you're not able to invest in other assets except the family of plans that is offered for you. And you can't really target the bond market. So for instance, like when interest rates were lower, you really can't just say, all right, I want to be in short duration corporate bonds. All they really have is they'll have maybe like a stable fund and some bond index fund, but you can't really construct it how you want. Same thing with the stock portion. You can't buy certain indexes. You could only maybe buy the ones that they offer. So there's not much you could really do. Is it okay? Yeah, it's fine. I mean, if you really know what you're doing, you could keep your money in those plans. But if you really want to optimize and have a portfolio that could generate income and work for you a little bit better and sort of create a second pension, you're going to want to most likely look at the benefits of doing a rollover. Look at the benefits, look at the things that maybe aren't benefiting you, have a talk with your advisor if you have one. Maybe it's not for you. That's okay. Just don't be in a situation where you feel that you're getting pressured into doing something. I've seen this happen a lot where individuals go to have a consultation with an advisor and they just feel extremely uncomfortable. They go in there and all of a sudden they come out just confused. They feel like they were getting sold something that they don't really want. Extremely high fee annuities or some sort of insurance policy. And now these are individuals that are older. They have a pension. There's really usually not a need for some of these policies. So just be very careful. If you have any questions, you could visit my website, firstshelbourne.com. You just always want to feel comfortable and you want to know what you're paying upfront in fees. That's the most important thing. I know I charge a 0.5% fee across the board, assets under management fee. So if you don't know what you're paying from an advisor, if you ask them what their fee is and it's like, we do a little bit of this, don't worry about that, we'll tell you later, run. You need somebody upfront and honest with you. You don't need somebody that's sort of wishy-washy and trying to hide things. So just be careful. But sequence of returns risk, extremely important. You most likely want to be more on the conservative side. You've built up this huge nest egg your whole career, and most people, you don't want to see this thing get crushed. And I'm not sitting here telling you where the market's going to go. Nobody knows. The market will compound over the long term, but why give yourself a huge headache? You've worked this huge career. You want lower stress right now. You don't need your stress levels to spike when the account goes down 60% in another credit crisis. So just be extremely careful and make sure you're getting fiduciary advice. So everybody take care. I'm going to be having more videos about retirement planning and all of this stuff, what I do at my firm, how I could possibly help you. If you have any questions, just send me an email. I'd be happy to answer them for you. So everybody take care. Have a great day.